All right, gang. So in this strategy session, we're going to cover the call credit spread. Now, this strategy here also goes by the name of the bear call spread or the short call spread. What's important to understand is that you're bearish with this strategy here. It's going to be executed on the call side of the options chain, and you're going to receive a credit which indicates that you're selling to open, which also means that you must buy to close. Okay. So the thing about this strategy here is that just like the bull put spread, most of the parameters are the same, except for this is if you're bearish. So if you want to make some money off of a stock that's going down, this is what you want to use here. So the cool thing about this is that whether the stock goes down, if it goes sideways, you're going to make money. Even if it goes up slightly, you'll still make money by expiration. It's just that you don't want it to make a big move by expiration. Okay, so again, I like these spreads. These spread strategies are really ideal if if you're not really good with direction, and you don't have to be, because you're going to make money off all the other variables. Okay, so normally if you're short, a stock, you will buy a put. Okay, but the other side of this is that you can actually sell a spread on the call side to do the same thing and make money, which is pretty nice. So when we actually do this here, what we want to do is take a look at the expected move, right? And we have a 26-point move up or down. So we want to execute this somewhere around there, okay? And before I even get into that, let me just give you the breakdown on how this works. If you guys remember in the earlier sessions, we went over the naked call strategy. I tell you that you don't need to do, okay? Do not do that. I do not recommend you to do that. Okay, so what we're going to do, because this strategy is a part of that, okay? You're using a naked call. So what I'm going to do is let me actually just sell this 340 right here. And we're going to sell single as a naked call. And I'm going to analyze the trade as if we executed this trade here. And as you guys can see that the loss potential on this strategy is unlimited. And because that risk is something that take hedge fund managers out the game, you don't want to be doing this strategy. I know there's some people that say, oh, I do this and I make money, and that's great. It's that one time that it doesn't work and you lose everything. So you don't want that to happen. And what you're making is limited. So your maximum profit is limited already. So it's really not worth the risk, okay? What you want to do instead of trading this raw, you want to put some protection on this thing, right? So what you'll do is you go back and you will buy back. Let me actually go back here. You want to buy yourself some protection. So you sell the lower strike, and then you'll buy back a higher strike for protection. So I'm going to just buy the 350, and I'm going to hit analyze trade, and bingo. Okay. You see when I take the buy off, the buy leg of the trade off, it's unlimited loss potential. Okay. When I put that on, now our risk is defined. The max I can lose is $926 on this trade. I like those odds much better that I'm only losing $926, okay? You still capped off with your max profit, and that's fine, but I want to have some protection with this thing. Now, of course, we don't execute this trade like this. I just want to give you the anatomy of this thing before we actually go into executing. So let's go back to the trade tab. And we're going to execute this in one block, one order, okay? Let's go to the 340 sell. And what I'm going to do is go to vertical, because this is a vertical strategy. Okay. And we're selling a vertical on the call side. Here we go. So I'm selling a 340. Let me adjust my strikes to make it 10 points wide. We're going to go to the 350. 350. Okay. So we're going to sell the 340, and we're going to buy back the 350 for protection. That's how this works. Now, the thing is that, when I hit confirm and send, you guys can see that, we're risking $921 just to try to make $79 here. And again, the probability of this trade here is really, really strong. Okay. You're looking at 88% probability, 88.78%. So, that's almost 90% probability that you're going to be right. So you're going to be, more than likely, you're going to be right in this trade, but you're only making $79. Okay. So what you can do to give yourself some more profit potential, because you're going to need to take in a higher credit. You're going to want to take in a bigger credit. So what we'll do is we'll sacrifice some of our probability here, our probability of success, so that we can take in a bigger credit. So I'm going to cancel this out. And again, we got what, 26 points here. So 26 points put us at like 333. I want to say, was it 336? So about 336. That's why we were looking at the 340 strike in the first place. But we want to go in just a little bit here, and let's go to the 330. So 330 strike. Now this is going to be within the move slightly. Okay. So that's the little risk that we will take. Why? Because the probability is still 78.88%. So I'm gonna sacrifice the 88% probability to take in a 78.88%. So that's like 79% probability of being right. That is still a huge probability. It's still a high probability trade that we're gonna win. So instead, I'm gonna execute this trade with that particular strike. Okay. So we sell the vertical, and we're gonna go with the 330, and we're gonna buy the higher strike, which is the 340 for protection. And bingo, now we're able to take in $185, as you guys can see. Okay. Mechanics work the same way as the other strategies are. Okay. As we saw the break-even price there, we got the 330. That's the one that we're selling. Okay. Plus the 185 credit that we're taking in. So you're going to add that, and then you get your break-even price there. Your max profit, we just slide this over here a tad bit. All right, so your max profit is going to be if you take a look at the mark on these here, if I can take a look at them here. Okay, here we go. You take a look at the mark here, we got the 330 strike. Where's the mark? Okay, so it's 3.348, okay. And then you have the 340 strike, and you just net those out. And then that's how you get your $185 credit. You got the $1.85 times 100 shares. That's $185 max profit. And then your max loss, as we went over earlier, that's the width, which is $1,000. And then minus the $185, that'll put you at the max loss at $815. So that's how you get the max profit, max loss, and the break evens here. So you'll see all of that there. Let's take a look here on the analyze trade to take a look at the Greeks. All right, so I'm going to remove the single legs, and we're going to actually go with our vertical here. So as we take a look at the vertical, it's just showing us that as the stock price moves down, which is to the left, we're going to make money, okay? So we're going to be making money as long as this thing stays down, and our maximum profit potential is $185 in this case. Now, if this thing moves against us, we're going to lose money, but the max that we can lose is $815. So that's the max that we can lose. Now, by expiration, which is this red, this break-even price here, just as long as it stays, under this, right, which is 331, almost 332, as long as it stays under here, we're going to make money, okay, by expirations, okay. Now, with the Greeks here, we have our deltas, which are negative, which indicates the stock price moves down, our position is going to make money. So it's negative because we're going to make money if this thing goes down. The gamma is also negative, so again, this is going to slow the acceleration of the deltas down. So we're not going to make as much money when it goes down because our gammas are negative, but we're still going to make some money versus the person who bought the long put. When this thing goes down, they're going to make a lot more money much faster than we will. But we're still going to make money, it's just going to be slower because of the gamma slowing it down. The theta is going to work in our favor, though. So as this thing is actually, as every day is progressing, we're going to make money off of theta. And then the Vegas is going to work against us if the volatility increases. Remember, we want to get in this thing, with expectation that the volatility is high, and we want to take advantage of the overpriced stocks, over the overpriced options, and expectation that volatility is going to decrease, and so we're actually going to be able to buy it back at a cheaper rate because of that. Okay, so let's take a look here and let's do a little scenario analysis here. Let's just add $5 to the stock price and see what happens to the P&L. The P&L is going to drop 29.9%, as you see, if the stock goes up. So we don't want that to happen, okay? But let's say if we drop this thing, let's go back and let's actually drop it. Let's drop it $5. So the 305. Now we're up 28% just by the stock price alone changing, okay? So we want the stock price to drop. If you're short, this is a strategy that we want to use. Now, volatility, we need for that to also go down. But let's just say if it goes up 5%. Oh, actually, let me actually just reset real quick. Let's reset this one to 310. Price. Okay, now we got the plus 5 on volatility, so we're down 22, negative 22. Now, if we actually had that volatility to drop, and we're up 32% just off volatility alone, okay? Volatility alone changing, we're going to make money off this thing, which is beautiful. All right, let's flatten that out. And then as time progresses, if nothing moves, as you see, we're making money. The days are progressing. We're going to make money off of time alone, okay? So those are the Greeks. That's how they're going to work out in our favor. And again, this is the bear call spread, or the call credit spread, as I like to call it. And this is an ideal strategy for when you're bearish. I really